Hi everyone, this is Accounting Made Simple with Akim. Today we'll be discussing IFRS 16 leases, accounting for leases. So the way I would do this video, I'll do it in three parts. Number one, accounting for leases generally, and also accounting for leases in the book of the lessee. The second part, that will be coming separately under accounting for leases in the books of the lessor, while I also do another video to cover the sale and lease back transaction under leases. So let's start by looking at the origin of IFRS 16. If you look at this, in January 2016, the International Accounting Standard Board um, issued IFRS 16 accounting for leases to replace the old IAS 17. Um, the scope of IFRS 16 is to look at the recognition, measurement, presentation, and disclosure of leases. So, because don't forget, I mentioned that in some of my earlier videos, that in accounting we need to look at four different things: recognition, measurement, presentation, and disclosure at all times. So, so let's also look at who are the parties to a lease contract. Let me use a diagram to display to differentiate between the parties to show what the parties are. The first party to the lease is the lessor. So let me add. Just want to make it very simple. Maybe yes, just do this. Parties to the lease. Uh, we have parties to the lease contracts. We have the lessee, and we have the lessor. So the lessee, one minute please. So if you see my designation here, according to IFRS 16, lessor is the party who leases the assets known as the right of use asset to another party in exchange for consideration. So in this case, we have an asset, an underlying asset, and so the party that originally owns the asset and decide to get a consideration by giving that right to use of that asset to another party is called the lessor. While the party that received that value, I mean in terms of possession of the asset, the right of use asset, he has the right to the use of the asset, and in turn pays in consideration, is who they call the lessee. Let me just complete this because I didn't complete it earlier. uh, yes, let me use this. Simple and straightforward. To make it easy just for our viewing, that's it. um, so in order to identify what a lease contract we have, whether we have a lease contract, we must first of all check whether that contract contains some element of control. You understand? So when you say you have a lease contract, I mean the one that falls under this category, there must be element of control, which is something that must have been stated as a control by the lessee. I mean, the person that has paid consideration for the use of the assets. And for us to be able to establish control on the use of the assets, the standard goes further to explain that number one, the lessee, I mean the person that pays consideration for the right on the asset, must have the right to substantially, the word substantially, all economic benefits. So economic benefit may be in the form of maybe we the lessee lease a land, maybe some hectares of land, and decide to use the land for maybe production purpose. So you know the lessee will earn economic benefit on the use of that land over a period of time. That period of time must be stated also in the lease. Um, it cannot be so also be in the form of maybe a sublease agreement. The lessee can decide to lease it out for somebody else if it contains, if the provisions have been contained in, or maybe the provision have been made in the contracts of the lease. So substantially all economic benefits. That's what the standard says. And also the lessee must have the right to direct the use of the assets. For instance, you can have a lease contract, and in certain cases, the maybe the lessor can decide to say that okay, for instance, you lease a vehicle, maybe a vehicle for a period of time, maybe it's supposed to be for 2 years, and the lessor can maybe change that vehicle, maybe can decide to change the vehicle with another vehicle. So it means that in that instance, the right to direct the use of the asset will change because the asset can be substituted. You understand? And if it's substituted, uh, that that will affect the right of control on the asset. But if it happens that uh, the lessor can just say that okay, while using this vehicle or maybe using this car, you must not go beyond this mileage, maybe considerably 70 miles per hour driving, maybe in the next 6 months doing 1,000 miles or 500 miles. That we can say, though the lessor is directing some aspect of the use of the asset, but still can still be classified under this category, and the lessee will still have the right to the use of the asset. But in an instance when the asset can be substituted with another asset, that means that right has been impeded upon. So let's take that note while considering a lease agreement, a lease contract, and accounting for it. So the standard goes further to say that okay, in any lease contract, if that lease say maybe above 1 year, considerably a long-term lease, maybe 1 year plus, that the lessee must account for it as a lease liability and not say an asset in its books. So um, what I'm trying to say here is that um, you know there are two things. When you have a contract, you can have a contract for less than maybe 1 year to lease maybe a land, maybe 6 months, or maybe you have the value of the lease is considerably low. The standard states that IFRS 16, as far as recognizing lease liability and an asset on the use of that asset, should be something considerably longer period, like a longer contract, maybe 1 year or plus, and the value should also be material. The value was not actually stated in the contract, but that is what the standard says. So um, in that instance, there has to be a lease liability and a right of use asset in the books of the lessee. So let's now go further to look at how we recognize and how we make measurements of the value of the lease in the books of the lessee. So there are two components we'll be talking about. If you look at what I've been saying, I've been talking about right of use assets and also lease liability. So the standard says that at initial recognition, a right of use asset, I use ROU here, contains the amount of the lease liability. I mean the lease liability that must have been recognized at the inception of the lease, plus all directly attributable costs or payments made on or before the commencement of the lease. It must be something that has been made on or before the when the payment has been made, or maybe the payment is made after the lease contract must have been signed. That will not be part of the right of use asset. That will be debited directly to the profit and loss account. So that is what the contract says, as well as the commissioning cost of the underlying asset. Maybe some dismantling costs or replacement costs or movement of the asset from one location to the other. So if it's borne at the commencement of the lease, that should be part of the right of use asset. Then subsequent measurement of the right of use asset is done by using the normal cost model under IAS 16, which involve initial costs less accumulated depreciation and also accumulated impairment losses if there's any. So for the lease liability now, because if you look at it here, I said ROU contains. So let me just make a small note here. Note. So insert. I said ROU asset is equal to ROU asset is equal to lease liability plus attributable cost directly. Let me use the word directly attributable cost or payment plus dismantling or decommissioning cost. Let me use decommissioning cost. So that's so looking at it here, the right of use asset is a bigger component and contains the lease liability itself plus all other costs and decommissioning costs. So let's now look at what the lease liability is here. So the standard says the lease liability is recognized at commencement by calculating the present value of the lease of the future lease payments. So if, for instance, you are supposed to make, maybe on a lease contract, maybe on annual basis, you're supposed to lease the contract for, let's say, 3 years, for instance, and you are paying £5,000 per year for the next 3 years. That £5,000 will need to calculate, because it's going to be paid on an annual basis. It's not being paid now, but it's going to be paid at a foreseeable future time, which is in 3 years. Those 3 years will aggregate it and will discount it to the present. So using the commercial, maybe loan rate, agreed loan rate in the contract. So we need to calculate the present value, and that will be the lease liability that will be recognized in the books at commencement of the lease, not in the future, at commencement of the lease. So subsequently, that value of the lease liability will change. How will it change? Number one, it will change as a result of interest. Maybe we apply some interest on it. That interest on the initial amount, because we have discounted it, we have discounted that amount, that interest will continue to grow on it. So when you charge an interest, it should increase that lease liability. And also, while we are making payment on the lease, that £5,000, as I made mention of, we are making that payment, it will reduce the value of the lease. That is subsequent measurement of the lease liability. So let me look at I made a simple example here, so let me just use that to describe how it will look like in the books of the lessee. So looking at the question here, I said company A entered into a lease contract to lease a land for 5 years. So in this case, let me do something. For us to do anything, I said that dates are very important in accounting, and number of years here says number of years is 5 years, right? uh then the lease payment per year is £28,000 payable at the end of the year for the next 5 years. So annual payment annual payment is what? $28,000. So annual payment is $20,000. And the question also goes further to explain, says company A incurred some legal fees attributable to signing and arranging the lease to the tune of $5,000. So other costs, other payment made. The payment was made at inception. That is $5,000. So both parties to the lease have agreed to apply a borrowing rate of 10% during the lease period. So discounting rate or discount rate is what? 10%. So show how the lease contract will be accounted for in the books of company A. So to now show this, there are two things we need to consider. Don't forget, the standard made mention of what we call lease liability and also right of use. So for us to arrive at these two, we need to have like a amortization table solution. So let me just draw an amortization table. Let me say lease amortization table or schedule. So when we have the years, we have no yes we have opening lease balance. Let me use that word. Then we have interest. Then we have payments on the lease. Then we have closing. Let me use that word. Closing lease balance. So opening lease balance. Let me copy this. Format painter. So the years on the lease is 5 years. We say 1, 2, 3, 4, 5. So the opening balance we don't know yet. And don't forget that the standard says that we should first of all uh, uh, look at the annual payment on the lease for that period of the lease and discount it to the present. That will be the value of the lease liability. So the first thing to do is to look at what the lease liability is. So we have lease liability. So we have the years, we have payment that we made, that we are going to make in each of those years, and we have the discount factor. Let me see this CF. The years are 1, 2, 3, 4, 5. So on each of these years, the question says $28,000. $28,000. So what is the interest rate? Discounting factor at, don't forget the question says 10%. So when we look at 10%, you know how that is done. We'll say 1 divided by, into bracket, 1 plus, what is the interest rate? 10%. Close the bracket, raised to power 1, which is the first year. So copy that down. Then so what will now be the present value? So the present value will be 28,000 times this, then this. So the total discounted value, which is the present value over that period of time, is sum of this to this for the next 5 years. So that amount that will be recognized as lease liability from the beginning of the lease is the 106,000. So I can have a link. Yeah. So while we're doing that, I would like to make like a debit and credit entry somewhere here. Let me say this is debit, this is credit. So the first thing to do from here, so that we'll not um, lump it up, is to look at what the lease liability is. How do we post it in the books? So lease liability, that is beginning. Let me use the word beginning. This liability at the beginning is how much? Is the 106. And which account do we debit? We debit right of use assets. That is our ROU. ROU. Oh, the same amounts. Yeah, that's it. So before we go further to do anything else, the question also says that Company A incurred some legal fees attributable to signing and arranging the lease. So that amount was spent. That £5,000, $5,000 was spent. So what we'll do is that we'll debit right of use asset, ROU assets. Let me copy that amount. 17. That is journal 1. This is JV1. This is JV2. Yeah. So right of use assets, that 5,000, and we'll credit bank because that amount was paid already. So let me use this. Okay, so we have completed the first part. So now what we now need to do is because we know that the interest rate is 10%, so we apply that 10% on this initial amount times 10%. Then what are the payments? The periodic payment, the question says 28,000, right? That 28,000 is the same amount, it's not changing for each of the years. So the closing balance of the lease will now be the opening balance plus the interest charge on it less the payment made. So sorry to do something. This. Okay, so the amortization schedule, we can put it in maybe this to distinguish it. Yeah. So the next thing is the closing balance for year 1 will be the opening balance in year 2, while we continue that way, and this will continue the same way that we have it, while the interest will be on the outstanding balance towards the end of the lease. So if you look at it here, so what we've done is we have the opening amount, which was calculated from the present value of the lease payments, is 106,142.03. Then we charge interest on it for that year, and also payments to be made That's 28,000 each of those years. The closing balance, this will be the remeasured amount. I mean, as at the end of the year, this 88,000 will be the value that will be sitting in our statement of financial position, our balance sheet at the end of the year. So how would this go? How do we go about this posting of this transaction? So then we'll go for that. Our journal again will be, the next journal will be for the interest payments, interest on lease. That is P&L. P&L. This interest on lease, sorry, that goes to the P&L is, that's 10,614, and the lease liability now is not at the beginning. The lease liability in the books, that will be the liability, will increase by that amount. That will be credited to the books. The next journal for this is still for the first year. The next journal will be JV4, which is the payment that we made. That payment will go out of bank, which is 28,000. The 28,000 go out of bank, then it will be debited to this liability account, that same amount. So that posting of the transaction will continue that way. Okay, it's not complete yet because this is the first year posting in the books, but there's still one more thing that we need to do, which is our right of use, total ROU assets. Now is, we have the lease liability of the 106 that was posted here, plus legal fees paid, which is the 5,000, right? So we had it together because we need to also look at the subsequent measurement of the right of use. So initial measurement, we know. The subsequent measurement will now have to look at what I made mention. I said subsequent measurement of right of use asset is done using the cost model, which involve initial cost less accumulated depreciation and accumulated impairment. So in this case, there's no accumulated impairment losses, but there is depreciation. So we'll need to depreciate it over that tenure of the lease, which is each year depreciation will now be that 111 divided by 5 years. So in each of the year, our next journal, which is JV5, will be depreciation, which is 22,228.41, and you know that depreciation goes also to the profit and loss account, while we credit accumulated depreciation, or we can say we calculate accumulated depreciation or the right of use asset itself, so that we can reduce that value. But this accumulated depreciation will reduce the right of use asset. So that is how we do it, and we'll continue to charge it every single year till the end of the lease. So in a nutshell, in the books of the lessee, we have what we call right of use assets, and a lease liability, and we account for it as we have stated in this example. Thank you very much.